Okay, so if let's say there's a sales return, okay, and there's a trade discount, okay, how do we do it? Okay, so let's look at December 15. Okay, Jane returned goods, this price $600. Okay, these goods were bought on 14 December and the cost of goods is $400. Okay, and then we have to go back and look at 14 December, okay, and we'll realize that there was a trade discount given. So if it is a sales return, okay, we also must apply this trade discount. Okay, so if let's say it's 15% trade discount, okay, sorry, 25% trade discount, okay, the remaining balance is 75% of $600, so $450. Okay, so if let's say there is a sales return, we must actually debit sales return 450, and because now we return back the goods, sorry, Jane returned back the goods to us. Okay, so she owed us less money. Okay, so it will be credit trade receivable Jane $450. Okay, we owned a promise of a lesser amount. Okay, so it's credit. Now, these goods actually cost $400 and it comes back into our business because it's a sales return, right? So it returns back into our business. So therefore, it is a debit inventory 400, and okay, it will cost less already. So it's credit cost of sales $400. Now, if you want to open up the different accounts, first account we have to open is our sales returns account. Okay, it is act like an expense or it acts like a contra income, meaning to say it's the opposite of income. Okay, so for income, it's a credit plus debit minus. But if it's a contra income, okay, it will be a debit plus credit minus. So sales returns increased, debit 450, balance 450 debit. Your particulars, the opposite of this transaction, this double entry will then be sales return will then be trade receivable Jane. 600 times 75%. Moving on, we have a trade receivable Jane account. Okay, for 15th of December. Okay, there is a sales return. Okay, so this trade receivable actually decreases by 450. So if there's a 8,000 debit existing balance, you minus away 450, you get a 550 debit. Okay. Now moving on to inventory account. This inventory, because this has been returned to us, so it increases by 400. Okay. There was an existing balance of 350 debit. So if you plus back your 400, it will give you 750 debit. Okay, and the opposite of this inventory in the double entry would then be cost of sales. Alright, okay, now we move on to our last account, okay, of this transaction. Okay, the cost of sales account. Okay, now it will cost less. Okay, so it's minus away 400. So there is a 3,250 debit. You minus away 400 will give you 2,850 debit. Okay, and the opposite of your cost of sale account in the double entry would then be inventory. Cost of sale account is your inventory. Okay.